In this environment, Ann Sonders, the Charles Schwab investment strategist extraordinaire, I got to ask you the obvious one here. If some of these types hitting the wires right now, David Stockman included, are right, the Federal Reserve is kind of damned if it does, damned if it doesn't. It goes ahead and hikes rates, even if it's a quarter point. It's not going to be enough to forestall this sort of junk bond contagion. In other words, all these issues that are so sensitive to the slightest uptick in rates that they all go kablooey. What do you think?
Well, I think in terms of the high-yield market, obviously the sensitivity is greater in terms of the decline in oil. And then there are a lot of comparisons, Stockton and others, to what happened in 2007 with blowout of spreads there. And then,
but hasn't all this been presaged before? And this has always been a worry, is the fact that now we're closer to a decision, the bullet point, or what?
Oh, I think leading into it, we've been cautious all year, and a lot of that is a function of not only what we've been seeing in the high-yield market, but uncertainty regarding Fed policy. I just think the difference this time versus, say, 2007 into 2008 is that there's a concentration in the energy sector versus a concentration in the financial sector back in 2007. And if you think about the proximate cause of high-yield problems in 2007 being a collapse in the financial system and massive leverage, that's bad for the economy, that's bad for risk assets. It is hopefully different this time in that the concentration is in energy. The proximate cause is the plunge in oil prices, which ostensibly is good for a consumption-oriented economy. So I don't want to whistle past the graveyard here, but I think that is the most notable difference between then and now.
You know, as you've reminded me as well, it's always different this time. In the past, we've talked with different crises. And, Lizanne, the argument that some have made for us being vulnerable to an even slightly upward ticket interest rates or a progression of them is that so many are so leveraged, particularly these high-yield guys, particularly those who last week, the one fund that just, of course, was closing off selling, that it wouldn't take much, even without rationale or reason, for people to sell off in a panic, right?
And that's one of the problems is contagion, but the leverage is concentrated this time. It's not systemic like it was back in 2007.
But wouldn't it spill over? That was Stockman's fear. Well, he's not been right on this. He's been waiting for that. Godot.
There's likely to be contagion, but I think the big question is, does what's happening with Third Avenue and maybe other funds, is it more like Lehman in 2008, or is it more like Orange County in 1994, which turned out to be the crescendo closer to the bottom as opposed to the first domino to fall in the collapse of the financial system? And I think it's more likely to be like an Orange County type of situation, or certainly that's the hope.
You know, you've always been, I'm not blowing smoke, but a calming presence in crazy markets. And you know what happens when we get crazy markets, or people hear just the report. You know, I've even heard it Friday night when I got back. People were saying, Neil, did I hear that a fund was not paying its investors? And then they just hear it secondhand, and all of a sudden they start panicking. What if my fund did the same? Boy, this sounds a lot like 2008. What do you tell investors who worry about that kind of language, that kind of talk?
So our tagline has consistently been, really since 2008, that panic is not an investing strategy. In fact, I wrote a report in 2008 titled that, and we've trotted it back out and edited it 3 times now. And what's remarkable to me about this entire bull market is how quickly investors move from maybe something close to enthusiasm or at least optimism right back toward panic again. And that's good news in the sense that it suggests the wall of worry that the market likes to climb is still very much intact. And I think because we went through 2 severe bear markets within a 10-year period of time, investors are so keen to make sure they're not dragged down with the next one that, and I don't want to diminish the importance of something like this, but I think that that initial panic reaction certainly has not served investors well throughout this entire bull market. And we think this bull market is ongoing, but that this is a tougher phase for it right now. And you can have pretty significant corrections.
What does tougher phase mean?
So when you get to a more mature phase in a bull market, and we do think that this is a secular bull market, but and I hate to bring this up, it's an extreme example, and I don't think we have a crash coming by any means, but remember the strongest secular bull market in history was the one from 1982 to 2000, during which we had the crash of '87. So when you sometimes say secular bull market, it sends the impression that every year it's just going to be hunky-dory and the market's going to continue to go up. You can have pretty significant corrections in an ongoing secular bull market. And I think it's the sentiment environment and just how skeptical investors have been this entire bull market that keeps me in that secular bull market camp. But I think given stretch valuations, what's going on in the high yield market, uncertainty regarding Fed policy, very weak earnings growth, that tells you that we're in a more mature phase and more subject to pullbacks and volatility, certainly like what we've seen in the last week and like what we saw back in August.
All right, so real quickly, Liz, and if you'll indulge me on sort of running this market. Wednesday, the Federal Reserve opts to raise rates a quarter point, the Fed funds overnight bank lending rate, widely expected. It does so, to hear David Stockton tell it, panic selling will ensue. The reality of the forces of higher rates and a chain of events is in effect, but it will do too little to help so many vulnerable players. You say what?
I say that I think markets tend to be discounting mechanisms and move in advance of particularly something that has been telegraphed as widely as this has. Now, again, I don't know what's going to happen when they make the announcement, but I have to think that some of what we're seeing, the volatility, weakness in markets, is associated with the expectation. I think the bigger surprise would be if the Fed did not do anything as opposed to if the Fed does something. Yeah,
that would almost surely trigger itself, and a big one at that, right?
And I think it would trigger a concern that, boy, they're so reactionary, and with every pullback in the market, they're going to step back and say, no mas.
Yeah. All right. Thank you, Liz Ann Sonders, very, very much.
Thanks, Neil.